We start off a lot of our initial meetings with a cash flow analysis. And essentially what we're asking people is come to the meeting with the information that you have on yourself, i.e. what's your investment value, what's your cash value, what's your house value, what's your pension values. And essentially what we're doing is we're taking a start on where you are today, and then we look forward and we try and get you to think forward. So you might be, for example, 42 today, and we would ask you, what does the finish line look like? And you say, well, it might be age 60. So we say, okay, well in today's terms, because we can't predict in future, what income would you want in today's terms at age 60? So I'll be stereotypical and we'll say £2,500. So we say, okay, £30,000 a year. So you've got £100,000 in assets, excluding your property, and you want £30,000 a year. So what we then do is we put that into a cash flow analysis, and we essentially say to the modeler, based on the information today, and we assume a growth rate of conservatively 4%. It'll vary. If you're a higher risk client, then you would be a higher growth rate, and if you're lower, you would be lower. But typically we would run a 4% analysis. What the analysis tells us is that, okay, well, based on what you're doing today, and for example, based on the contributions you're making to your employer-based pension scheme, and if you do nothing else, then you would need to accumulate growth at, say, for example, 10%, which means you're only forecasting 4 just now. You're in a cautious fund. Are you in the right fund? The answer predominantly would be no. You would need to take more risk in order to get the higher growth rate and speculate a bit more over a longer period. If that's not your comfort zone, what we can also tell is, okay, well, you've got a disposable income of, say, £1,500 a month. What we can say is, well, actually, to bridge the gap, if you don't want to take a higher risk on your investments, then you could pay in £1,000 a month. And if you pay in £1,000 a month every month for the next 18 years in the scenario which is covered there, then that may bridge the gap. So visually, I think what we're saying to people is, let's find out where you are today, let's find out where you want to be, and let's see what the gaps are. The good news is, if people are in, they've done really well today, there are no gaps sometimes. But if there is a gap, then you can see what it is with plenty of time in advance, and you can actually set to work on, reducing that gap as quickly as possible.